All right, here's the deal: doubling your money. Everyone wants it, but how do we actually get there? Today, we're diving into one of the simplest yet powerful formulas in personal finance: the Rule of 72. Whether you're looking to build wealth, retire comfortably, or even just feel financially secure, the Rule of 72 gives us a clear path forward. This formula makes understanding the growth of our money both straightforward and inspiring. So let's walk through how this rule works, how compound interest plays a role, and why it could be the game changer you've been searching for. Let's start at the top. The Rule of 72 is like a shortcut, a mental math trick that shows you how long it'll take for your investment to double given a specific interest rate. You divide the number 72 by the annual interest rate, and that answer tells you how many years it'll take for your money to double. For instance, with an interest rate of 6%, your money would double in about 12 years. And this works for any rate of return, making it versatile and practical. The beauty of this rule lies in its simplicity. No need for complex calculators or fancy financial models, just this one easy formula. The formula might look like a simple division, but there's a lot going on in the background. The number 72 isn't just a random pick. It's based on the magic of logarithms, which balance out as a great estimate for average growth rates. This formula works best with interest rates in the range of 5% to 12%, which is what most people can reasonably expect from long-term investments. So, if you're working with an 8% rate, you get 9 years of investment growth. That means every 9 years, your investment will double. Now imagine you're investing for 18 years. With an 8% return, you're not just doubling your money once, you're doubling it twice. If the Rule of 72 tells you when your money will double, compound interest tells you why it doubles. Compound interest is, essentially, interest on interest. Every time you earn interest, that interest gets added to your principal, and then you start earning interest on this new amount. This repeated cycle accelerates the growth of your money. Let's break it down. If you start with $1,000 and earn 5% in interest on a high-yield savings account, you'd make $50 in the first year. In the second year, you're not just earning 5% on that original $1,000, but on $1,050, which means you'll earn more. It keeps building, and the bigger your balance gets, the more interest you're earning, and that's the power of compounding. All right, so how can you use this rule to multiply your money? Let's look at a few scenarios. Let's say you're saving up for your kid's college fund. You've got $10,000 set aside in an account earning 6% interest. According to the Rule of 72, your money will double every 12 years. So in 12 years, your $10,000 becomes $20,000. And in another 12 years, that $20,000 turns into $40,000. Or maybe you're thinking about retirement. Say you invest $50,000 in an index fund averaging 8%. Following the Rule of 72, your money will double every 9 years. So after the first 9 years, you'd have $100,000. In 18 years, that becomes $200,000, and in 27 years, it will grow to over $400,000. All of this happens just by leaving your money invested and letting compounding work its magic. We've talked about returns, but let's get real about interest rates. This rule gives us a sense of how different interest rates impact our doubling time. For instance, at a 3% rate, it would take 24 years to double your money, but at 10%, it would only take about 7.2 years. That's a huge difference. Higher interest rates shorten your time to double, showing the advantage of finding investments with solid returns. So, when you start to understand this, you see the importance of even a small percentage increase. A 1% or 2% difference in your return might not sound like a lot, but over time, it's the difference between doubling every 8 years or every 12 years. With that in mind, you will need to find a high return rate investment This might seem daunting, but there are options out there. Many look to stocks or funds that track indexes like the S&P 500, which has historically averaged about 10% annually. And with the rule of 72, that means a doubling time of roughly 7 years. Stocks come with risks, but when you play the long game, they can help you ride those growth waves. Or consider bonds or other safer options with lower risks, which might yield 4 to 5%, which will mean more years for your investments to double. While the doubling time is longer, 14, 18 years, it's still growth that compounds over time. The key is understanding what interest rates you're comfortable with based on your risk tolerance and goals. Of course, while we're aiming to double our money, we also need to watch out for inflation. Inflation is like compound interest, but working against us. It's the gradual decrease in purchasing power. If inflation is at 3%, then prices double every 24 years. This means the value of the doubled amount might not be as high as it seems in today's terms. That's why we look for interest rates that can outpace inflation. If your money is only growing at 2% while inflation is 3%, you're technically losing purchasing power each year. But with an investment returning 6%, you're not just doubling your money over time, you're also protecting its value. While the rule of 72 is incredibly useful, it's not perfect. It's an estimate, not a guarantee. Real-world returns vary, and investments come with risk. If the market goes through a rough patch or you face unexpected expenses, your journey to doubling could be delayed. Another pitfall? Taxes and fees. If you're earning 8% on paper but lose 2% to fees and taxes, your effective rate drops to 6%, which means a longer doubling time. So keep your eye on net returns, what you keep after fees, not just the gross return. Think about where you want to be in 10, 20, or 30 years. Every dollar you invest today has the power to double and double again. The rule of 72 isn't just a formula, it's a gateway to understanding how your money can grow. Each doubling of your investment brings you closer to financial freedom, and with each year, your patience pays off. So whether you're starting with $500 or $50,000, the journey is the same: consistent, long-term growth. Take the rule of 72, let it guide you, and know that with time, patience, and a solid interest rate, you're on a path to a more secure, wealthier future. And that's not just math, that's the power of compounding.